Hi guys, good morning and welcome back to my YouTube channel. And today's video is going to be one of the unique video because in this video for the first time I'm going to discuss adjustment in option selling, which has a very high winning probability. You can do the back testing whatever I show in this video and you yourself will see that it has a very high winning rate in option selling. This strategy which I'm going to discuss, it is a strategy part of my next course which I am launching by this weekend, that is Mastering Expiry Day Option Selling. As you know that from September onwards there will be everyday expiry, that is Monday to Friday is going to be expiry day. So going forward you have opportunity to sell option on every day Monday to Friday. So that is why I am coming with a new course, that is Mastering Expiry Day Trading. So in this new course I will discuss about the how to trade on expiry day, and it's an advanced level kind of course where I'm going to discuss 10 strategies for option seller. Out of 10 strategies, 6 strategies are going to be directional based strategies and 4 strategies going to be non-directional based strategy. And out of 4 non-directional based strategies, few strategies also I'm going to discuss how to do adjustment. Adjustment is something many new traders, they don't try to learn adjustment thinking that it's very complex subject. Because when you go to YouTube channel, you see so many videos on adjustment and understanding is very difficult. But in this video, I'm going to show you how I do the adjustment in the more simpler way so that you don't have to watch any videos for adjustment. So I'm going to share that how I do the adjustment, which is part of my new course, that is Mastering Expiry Day Trading. But as a gift, I'm sharing it with my all YouTube subscribers so that they can also learn how to do adjustment. So don't ignore this video even though you are an option buyer. Watch this video because maybe in future you will become option seller and you should know what is adjustment, and I've shown you one of the more simple way to understand how to do adjustment in option selling. And now let me go to my laptop and let me share that one of the strategies which is part of my new course, that is Mastering Expiry Day Trading. Guys, now we are coming to the next non-directional based option selling strategy. This is the strategy number 8, and that strategy is deploying short strangle and adjustment. And it happens to be one of my favorite strategy in non-directional based trading. If you go and ask option sellers, you will see that most of the option seller will tell you that his favorite strategy is straddle. Straddle is favorite strategy because straddle you'll get a maximum premium compared to strangle. Maximum premium you will get in straddle because it is at the money option, right? And at the money options and always have better premium. I prefer doing strangle most of the time compared to straddle because it is much more peaceful compared to even straddle. Because straddle you sell at the money option and anytime it can start moving on either direction and you have to keep doing adjustment, right? Here strangle you get a bigger range and you don't have to do adjustment for very long time. Many days it happens that you don't have to do strangle adjustment only and still you make profit. So that is what I'm going to discuss in this strategy, where occasionally you may have to do the adjustment, but only drawback of strangle is risk reward will not be very good. Okay. So risk reward will not be good. If you are a trader who looking for only risk reward trade, then strangle is not much preferred. But if you are a trader who is focusing more on winning probability rather than risk reward, then strangle would be one of the best strategies. Second thing is that many of you may be very new to adjustment and all this, right? Maybe you know strangle, but you must have never tried it because you don't know how to do adjustment, because it's very complicated. You think that you watch some videos and you think that it's a complicated subject. But in this strategy, I'll make it so easy to understand. Here, I'll make it so simple way. I'll show you how to do back testing also in the option software so that you can try it on historical data. And another thing is that even this strategy you can try it without even looking at the chart. In fact, you don't have to even look at the chart, only you will be adjusting with the help of delta. Let us see when to use strangle. Days when one expect price to stay within a specific range throughout the day and stays between the range till the expiry. So what is the maximum profit potential in short strangle? Maximum profit is the total premium collected. If market stays within the range which you have marked, then you can make maximum profit on that. Maximum risk in short strangle, unlimited risk if there is no stop loss or no adjustment. If you don't keep stop loss, If you don't do adjustment, then losses can be unlimited because triangle have a limited profit and unlimited risk. Now let us discuss about the price action criteria. Now you have to focus here what I am saying, okay? Because this is the most important entry, exit, everything. Whenever there is a wide CPI in Nifty, Bank Nifty, Fin Nifty, one of the days for short strike because market likely to stay sideways, right? So that is the price action criteria. Just like straddle where I said wide CPR have a better win. But one thing in straddle is you can take directional once one-sided of call or put option stop loss hits. You can take a directional based trade in straddle. But strangle you don't do that, right? So that is why strangles preferably wide CPR or day where you expect market to stay sideways. Okay. Sometimes CPR can be average size, still market can stay sideways. There is nothing like only on wide CPR day market stays sideways. It can stay sideways on average CPR. So I marked wide CPR, but sometime average CPR also day it can stay sideways. Now what is the entry plan? Enter at the first candle close by selling OTM call and put option which have 0.20 delta. So that is what I said. This strategy is totally different than how we discussed in straddle. It is purely based on delta adjustment or delta hedging. You should select both call and put which have 0.20 delta or near to that. 0.21, 0.22, 0.18, 0.19. Somewhere near to 0.20 you should look for. Not like 25, 26, 30 and all this. And remember, this strategy can work well on non-expiry days also, provided premium is good and it's not a big trending. If premium is good, it's not a big trending day. On non-expiry days also you can apply this. So that means non-expiry days also you can try this strategy. And I have done the back testing and I have seen on non-expiry days also it can work very well. And what I'm going to do after explaining this strategy, I will do the back testing for entire 1 week, Monday to Friday with the same strategy. And you yourself will see that it can work on other days as well. Only time it may not work when there is a big trending day. That means market opens and start going down, making a big move. Then it may not work either on upside or downside, but it should not be trending day. Zigzag day, okay, but it should not be big trending day. Okay, that is something you should remember. Adjust the position only if there is a difference of 0.20 delta between call and puts. So when you have to do the adjustment, only when the delta difference comes to 0.20. Okay, I'm going to explain all this on the whiteboard so that you understand better. That means 0.20 call delta which you have chosen become call 30 or put delta which you have chosen at 0.20 became 0.10. Then what is the difference between this both? Difference is 0.20, right? Then you have to start doing adjustment. Or vice versa. That means it becomes 0.30 and it becomes 0.10. Then you have to do the adjustment because difference is 20. Or it becomes 0.35. This becomes 0.50. Okay. So that is how you have to do when difference comes to 0.20 between both. What is the exit plan? Because it is not a holy grail that every day it works, right? Sometimes it will not work when there is a big trend. So exit plan is while adjusting, if triangle eventually becomes straddle, then exit. That means what is triangle? Selling out of the money calls and puts, right? If keep adjusting, finally becomes ATM. Okay, after adjusting, your both strike becomes ATM. Then what it has become? It has become a straddle, right? From triangle, it has become straddle. Then exit. Sometimes what may happen that late afternoon already you are in good profit, and then it becomes straddle. Then what you can do is you can hold on to trade or trail your profit. Another way to exit once loss comes to 1% of capital. That means if your capital is 10 lakh, what is 1%? 10,000, right? Once your 1% of stop loss hit, exit. And finally, if you are in profit, then exit at 320. Okay. If there is no adjustment, trade has been going nicely entire day, market is sideways, you are in a good profit. And finally at 3:20 p.m., exit the trade. This short triangle strategy can work well on non-expiry day also, provided premium is good and it is not a big trending day. Already I discussed here also, right? It can work on non-expiry days and I'll do the back testing and I'll show you. Now I'll go to whiteboard and I'll explain you much detail about everything. Okay, first thing what I said, this strategy is purely based on delta hedging, right? Adjusting the deltas, entire strategy based on delta. Unlike in straddle where we focus on premium, where we focus on the chart, everything. And I'm assuming that you know what is delta because delta is one of the option Greeks And I assume that all of you know delta, because as I said, this course is not a basics course. This is an advanced course where I'll not be discussing too much into delta, gamma, and all this. I'll be directly going into the strategies. But delta is something which will decide how much your option will move. For 100 points move in Nifty, how much your option will move, whether it moves by 20 points, 30 points, 50 points, that is what decided by delta. So the option which have a higher delta, say it has a 0.50 or 0.80, that means it is more sensitive to underlying. Okay, if delta is higher, that option is more sensitive to underlying movement. That means it can also move very fast when underlying is moving. But if you are going for a delta of 0.20, 0.25, 0.10, so these options have less sensitivity to underlying. That means this can also move, but this will not move as fast as options which have a higher delta. That is why I said criteria in this strategy is we are going to choose a delta which is around 0.20, so that we'll get a room. That means even though Nifty starts going up or going down or make a big swings, this option will not move much because delta is lesser. All right. So what is the main funda of this strategy is? This strategy is we are selling strangle out of the money. And what is adjustment? I said adjustment means as market is going up or down, we again sell out of the money options which have a similar delta. That means we just follow the market. That's why we go for a lower delta and we'll try to keep the delta neutral so that we can follow the market and try to stay out of the money. Choose out of the money call and put which has a 0.20 delta or lesser. Lesser means don't go for 10, 12, 14, 15 and all this, because when you go for lesser, you will not get the premium, right? So at the same time, to get the better premium, you can't go for delta of 0.3, 0.4, 0.5. So that is why we have to balance in such a way that we get a decent premium, same time delta also less. Okay. So that is the first criteria. So when we will do the adjustment, I said whenever you have gone for 0.2 delta each, okay, call and put, and market started going up. Market started going up. So what happens? This is the call option. This is the put option, right? This call option also start going up. Suppose it goes to 0.30. Here you are making a loss. Why you are making a loss? Because you wanted market to stay sideways, but here market is going up. So here you are making a loss, but here you are making a profit because this 0.2 delta must have become 0.1 because it has become further out of the money, right? So here you made profit, you made a loss. Now what is the difference? Difference is 0.20. Now what you will do? You will do the adjustment. How you will do the adjustment? You will do the adjustment for call option which went to 0.30, put option which went down to 0.10. You will cut your put position here. You will choose a put strike which is again matching this delta, right? Again it has become a delta neutral because here also 0.3 delta, here also 0.3 delta, right? So that is what the objective is, to neutralize the delta. That means if it goes 0.35, call option became 0.35, then put option you squared off and you chosen a put option which is also around 0.35. But it is true that you will not get exactly 0.35. It may be near to that. Don't go above this. Okay, don't go for 36, 37. Try to go same or lesser than that, like 31, 32, 30. That is fine. But don't go for 37, 38 and all. And when you square off the position, when you keep adjusting and finally your call and put option both become at the money option. When it becomes straddle, you should square off the position. Call option also becomes 0.5. Put option also becomes 0.5. That means it has become straddle. That means you are now at the same strike, call and put option. In that case, what you do, you can choose to square off your position with a small profit or small loss. If you are in very good profit, in that case, fine, you can trail your profit. But this is the exit method, right? When it becomes straddle, or you see 1% loss of your capital on your screen. When your MTM become 1% loss, you exit manually all the legs. Remember, okay, strangle have a unlimited risk. If you keep your trade open like that, then losses can be unlimited. So that's why Risk management is important. You have to have that discipline that the moment you see 1% risk, 1% loss on your capital on your screen, come what may, you will not wait anything. You will just scare off the position, right? So that is what this strategy is all about. And what I said finally, risk reward will not be very good in this strategy, but winning probability is good. Okay, win probability is good. If your focus is only on having a bigger winning probability rather than risk reward, then this is one of the best strategies. So now what we'll do back testing on one of the week where I'll do the back testing from Monday to Friday. Okay, Monday to Friday, every day I'll do back testing. And when I'm doing back testing, you will also know that how to do back testing so that you can also do back testing to know how much this strategy can work. Okay. So what I've chosen is I've chosen the date from 24th of July to 28th of July. I'm keeping the chart as a reference. Now what we'll go to option software and let us start with the back testing from 24 to 28 July 2023. Okay, this is the Stockmark website. This is the option software where you can do the simulator, back testing and everything. So for expiry 27 July, I'm starting from 24th of July, 9:28. So watch this carefully so that next time when you have to do the back testing on the simulator, you will know how to do it. Okay, 24th of July, when you go to Stockmark, you can see that on one side, call option, one side put option, one side it will show you the strike. Okay, when you come here, it will show you that at 9:20 a.m., 24th July, what was the spot? What was the Bank Nifty spot at 9:20 a.m.? So 9:20 a.m. when we came here, we have to look for what? We have to look for delta. Where to see the delta? Delta is here. You can see that last traded price. You don't have to worry about the last traded price. Only thing you have to see is the delta. The bracket, what you see, that is the delta on the both call and put side. Okay. So what I said, we should go for delta, which is around 0.20. You can see here, 45,500 put option have a 0.21 delta, which is nearer to 20. So I'll add one lot here. All right. I have added one lot here. And now we'll go to call side and we'll see the delta, which is around 20. So you can see that we got exactly same delta, which you will not get every time same delta, but here we got the same delta, right? 0.21, 0.21, and premium is 96 and 81, which is nearer, but you don't have to worry too much about the premium. We are only focusing on delta, right? So what we will be looking at, only we are looking at the Greeks. So now what we'll do, focus here, P&L, we are trading with only one lot. Okay, we are trading with only one lot for understanding. So maximum profit potential is this much, and risk, look at this, undefined, right? Profit is capped, but risk is not capped. Risk loss can be unlimited. Probability of profit also very good is in this strategy. Now we'll run the simulator for every 50 minutes to see what is the P&L and what is the delta. When we will change, when this difference between becomes 0.20, right? Currently it is 0 because we have chosen the same delta, right? Focus here and focus here. So let us start with every 15 minutes. Look at this. Is there any big delta difference? No, right? Small difference. Profit also, small profit is starting. So let us keep running it for every 50 minutes. Look at the delta. No much difference. No much difference. Still within the control. Now still within the control. So either side it goes 0.2, then we'll adjust this. It is 0.15, right? We are already in profit, but delta has not touched 0.20 difference. So still we are holding on to. Now it has come to 0.12, 0.7, 0.5, and you can see that profit also going up. And you can see that delta has not come to 0.20 difference, and 320 we are going to square off. So we have squared off the position at 320, and delta was a small difference of 0.8. It did not matter much, and the day ended with a profit of 774, one lot, right? And the good part is we did not have to do any adjustment. Without any adjustment only, we booked the profit. Now let us go to the chart and see how was the day on 24th of July. Okay, this is the 24th of July chart. So you can see that market opened near the CPR. It went above the CPR, stayed sideways, again came down, and finally at 3:30 market stayed sideways, right? So entire day it was a sideways days, and obviously sideways days there is a very high chance of making profit. Though CPR is not wide, it's a average, but it's not a narrow, right? So now we'll go to the next day and see how Strangle behaved, and we'll change the date to 25th, and time is 9:20. And what we have to do first? First we have to look at the delta which is matching, right? Okay, we'll go for 0.23 here, and this side we can go for 0.2. Okay, so we have a position which is delta of 0.3, 0.22, small difference, right? Let us start the simulator to know how this day went for us. Okay, so you can see that there is nothing much difference in delta. Profit also nothing much, small minus. Okay, delta not much difference. Now you can see that 0.16. Let us go with 5 minutes to see if there is no. Okay. Now what happened? You can see that now delta has crossed difference of 0.20, right? We said it has to be between 0.20, but here delta has difference is increased by more than 0.20. Now we need to do adjustment, right? Now you will see that how you will do the adjustment. Now first what we'll do, we'll go to the position and we will square off the position which is already in profit. Call option is already in profit, right? Let us square off this position, and we have square off this position. Come to the Greeks. What is the Greek? What is the delta? 0.35. Now we have to choose a delta which in the call option which has 35 or less than that. Let's come here, and okay, we'll choose this which is 0.32 delta, and let us add it here. So now we have a again delta neutral, difference is just 0.3, right? So now what we'll do, we'll again start playing for 15 minutes. You can see that there's nothing much difference between the delta, but position is still in the loss. So time is around 1:15. Trade is still in the loss, but delta also not moving much. Now delta is increasing, right? Delta difference is increasing, and trade also in a small loss. Now almost it coming near to 0.20. Okay, you can see that 0.19, it has become 0.12. So let us again start with the 15 minutes. So you can see that now slowly position is coming back into the profit, and our delta also, which was difference was big, now it difference also came down. So you can see that now we are in good profit. It is 3.5 now, and we are profit of almost 498 for a single lot. And you can see that delta also not much difference, and now 320. So at the time of 320, delta is 0.06, and we made profit on Tuesday, July 25th also, right? So now let's go to the chart and let us see how was the day on 25th July. Okay, this is the 25th July. What happened is market stayed sideways for a very long time, then made a small down move, then again started going up, and you can see that then it started falling where we have done some adjustment. Again market stayed sideways, and finally market closed. So you can't say it's exactly trending day, right? Had market started going down, right, then it would have been become a trending day. Then maybe we had to do more adjustment. But since we did not have to do adjustment, because after that market stayed sideways, right? And still we made profit on 25th also. Now we are coming to the 26th July, and we have to choose the delta which is around 0.1. Let us choose this 45,500 put option, and this side we have to choose a delta. Okay, we'll choose this 46,300 call option which is 0.9 delta. So difference is just 2 points. That is fine. So what we'll do, we'll start playing every 15 minutes. You can see that small loss, again loss turned into profit. Now it's in the profit, and you can see that delta is not moving much, right? Delta still neutral, and we came back to the profit. You can see that still there is nothing to do adjustment. Still trade is going well. Still trade going well. Still trade going well. You can see that it came near the 0.18. But what we said, we said we'll adjust only if it difference comes to 0.20. So we did not have to do the adjustment. Now you can see that 0.13, 0.17. And finally, at the market close, difference was still our criteria of 0.20, and profit we made almost 366 per one lot. So 26 July also we made profit. Now we'll go to the chart and we'll see that how it is looking on the chart. Okay, this is the 26th. Market opened near the CPR and you can see that entire day market stayed sideways. There was a small move on the upside, but there is not a huge move, right? This is also kind of sideways days, and 26th also we made profit. Now let us go to the next date, that is on 27th. Now we have come to the 27th July, and first we'll select this strike 46,000 call option, which is 0.22 delta. We have selected that. Now call option side will come, and we'll select this, which is 46,500, which is 0.2 delta. So delta difference is difference of 0.2 only. Let us start with the simulation, and you can see that there's nothing much difference. We are already in profit in this trade, and there's no much difference, right? Almost same delta as of now. Let us play it. Okay, still we are in profit, and suddenly you can see that suddenly at 11.5 profit turned into loss, and delta also suddenly it has become 0.34. What we are saying that when we will adjust the position, when delta becomes 0.20 or more, right? Now we have to adjust the position. How will adjust the position? We cut that leg which is already in profit. So you can see that 46,500 call option, which is already profit. So we'll cut that leg and we will add another leg of call option, which is close to this 0.2 delta. But remember what I said, when it becomes ATM, when this triangle becomes straddle, right? When it becomes ATM or straddle, then it is better to square off the position rather than fighting with the market and keep doing adjustment. If you want to adjust this delta, now you have to go to nearest strike, which is, let us say on the call option, which is the nearest. You can see that this is 0.45. We will not go for 0.5. Let us go to 0.32, which is not very nearer. Still, you can see that it is already giving you difference of 0.10 delta, but we'll go for lower so that we'll get some room to adjust, right? Now what we'll do, we will again go for next 15 minutes and see how it is working. Now you can see that still it is not working, right? Still trade is going in a loss, delta, P and also. When condition comes like this, where even after adjustment, trade is not going well, then what you can do is you should be ready to square off your position, because most probably that day may be leading into trending day, right? Initially it was sideways days. Maybe that day is going into the trending day. So that means it is not a day for strangle. So be ready to square off your position when trade goes into 1% of your capital. So your margin is 1.07 lakhs. So that means 1% is around 1,000, right? So your maximum risk is 1,000. So when it comes to 1,000, you will square off the position, no question asked. Now what I'll do, I'll not do the adjustment and just run for another 5-10 minutes. If it's still giving me loss, I will square off the position. So now we'll go for just 5 minutes to see whether this trade can work or not. Look at this. Trade is not working out, right? Even if you do the adjustment, trade may not work, because now look at the delta. 0.56, right? You can match the delta and do the delta hedging, but it will only lead to bigger and bigger loss if the trade still going down, right? Because when delta is going up on the put option side, mean what? Market is going down. Okay, we'll see it on the chart also. But what I wanted to show you here is that you have seen that it worked on 25th, it worked on 26th. That doesn't mean that every day it works. So you have to have a risk management in control. That means when you see that it is almost 1% of your capital, no questions asked. Go back to your positions. Don't do any adjustment. Cut off all the position. You are done for the day and come back next day. Okay, this is the 27th of July chart. You can see that first couple of hours, market was staying sideways, and you have seen that it was giving us profit initially in strangle, right? Without even doing adjustment, it was giving profit. So you can see that around 11 o'clock, market started collapsing, right? So market started collapsing and kept on going down. So that's why you have seen that even though we were doing adjustment, but still it was giving loss, right? Why? Because market was going in a strong trend on that. After the initial one and a half hours of staying sideways, then it went down. So that is what I said. On trending day, you should know when to exit. Now we are coming to the last day of the July, that is 28th of July, Friday. So since Friday new expiry starts, so you can see that now new expiry is 3rd August, right? So it was 27 July till Thursday. Friday comes under next expiry, that is 3rd August. So that's why you can see that date also changed here. So now what we'll do, we'll go to 920. We'll look for the delta which has around 0.20. So you can see that 44,900 put option have a delta of 0.2. You have selected that. Come to call option side, and this is the delta. You have selected it, right? Now you have selected the delta which is almost close to each other, right? 0.2, 0.2. Now again we'll start running for every 15 minutes. You can see that delta nothing much difference. Small loss is showing. Now loss has converted into small profit. Nothing much change in delta also. So let us play for every 15 minutes. You can see that delta is not changing much, and you can see that profit is growing up, profit is going up. So let us again play for every 15 minutes, and it's 12:20. You can see that we did not do any adjustment. There's no much difference between delta, profit also coming in this trade. So let's play till 3:20. No much difference in the delta, profit still there, no much difference. Now its time is 2:05. Still we are in profit in this trade. Peaceful trading, right? Peaceful day of trading. Short triangle working without any adjustment, right? You have still not done any adjustment. Still delta is in control. Profit also there. 235. Still delta in control. 250. Still delta in control. Profit is almost 671 without doing any adjustment. And finally at 3:20, right? 3:20 we close the trade with a profit of 776 for one lot each. Delta also did not give us much difference. So without doing any adjustment, entire day we made good profit in strangle, 766 per lot, right? So that is what I was saying that earlier. Short strangle have a better win rate. And why strangle can work most of the time? Because 70% of the time market stays sideways. So that is how triangle can work most of the time if you know how to do adjustment. Now let's go to the chart and let us see actually how was the day on 28th July. And this is the 28th July. Market opened gap down, stayed sideways for most part of the day, right? It took the resistance from 20 MA most of the time, but you can see that it could not collapse and goes down. So this day also, you can say it's a sideways day, and that is how we made profit in triangle. Okay guys, you have seen how easy doing adjustment is, and that strategy number 8, deploying short triangle and adjustment, it is one of the 10 strategies which I have included in my new course, that is Mastering Expiry Date Trading. In my new course Mastering Expiry Date Trading, it is not just discussing what is straddle, what is triangle. Also I discussed how to do adjustment, and also I discussed price action criteria along with the chart, when you have to go for straddle, when you have to go for triangle. Also I discussed 6 directional based strategies which I personally use in expiry date trading. That also I discussed in my new course. So wait till the weekend, and by the weekend you will see that link below this video in the description section about new course Mastering Expiry Date Trading. So if you felt that whatever I discussed in this video, that strategy along with the adjustment, it is very simple to understand, then all my strategies are very simple and easy to understand. If you are interested, you can purchase my course once I launch this course by this weekend. Along with that, my day trading webinar, that is 25 day trading strategies in Nifty Bank Nifty, that I am still continuing. That is specially for both option buyers and option sellers. And this new course specially for only option sellers. So if you are a hardcore option seller, then this course is for you, where I am sharing lot of my knowledge. So that's it guys about this video. I'll see you soon with a new video. Until then, bye and take care.